What's going on, guys? Mike here, and welcome back to another video. Today's topic is for everyone, and that is we're going to be looking at how there's two distinct opinions on whether you should have global diversification or all of your funds in the US stock market only. Now, leave a comment below on which investor you are and whether or not you're remaining the same after this video. So we're going to be looking at two primary ETFs, which I think everyone is going to be aware of, and that is XEQT for our global diversified ETF, and then we're going to be comparing it to VFV. I've seen over the forums like Reddit how people are always in this discussion on whether or not they should go all in on XEQT, go purely on VFV, or go on a combination of XEQT and VFV together. We're going to be looking over each of the underlying assets of these ETFs, the diversification considerations, because there's also always an argument that if you're investing in VFV, people feel okay about it because it's they're investing into the top 500 companies that have global exposure. So we're going to talk about that as well. We're going to recap the management fees, the historical performance. We're going to look over a few articles online on the predictions of the future. We're going to be looking at the dividends and obviously my personal recommendation. So if that interests you, stay tuned and let's get right to it. So we're going to be starting on BlackRock's website, specifically on XEQT. So like I've already mentioned it, XEQT is the ETF that we're going to be using for our global exposure. Now, if you're new to the channel, maybe you're new to investing, maybe you don't know what XEQT is, but when I say it's global diversified, it is one ETF that it invests into basically the world indexes, okay? If you're looking at for more detailed video on XEQT, I do have videos here. I'll link in the description and at the top here. But some of the content will be redundant. I will be kind of talking about it here, but not as in depth compared to the videos. So, like I said, the primary objective of XEQT is to have exposure to the world indexes. So, what does that exposure look like? Well, if you look here, it essentially will have near 45-46% in the US stock market. Now, I do want to highlight that in XEQT, it invests in the total US stock market, which I believe is roughly around 2,000 companies, give or take a little bit. Whereas VFV, once we get there, you're going to notice how it only invests into 500 companies. So just stay tuned for that. Obviously, going down the list here, we're going to have near 25% in Canada, and then the rest of it is essentially in international countries as well as emerging markets. So, obviously, you can see this is very diversified. It is in multiple indexes in multiple areas of the world. So, if you have, say, Australia having issues with, a financial crisis, well, you're going to have a small portion of your capital in that country. Or what happens if, say, the US goes down, having, say, another financial crisis like they did in 2008? Well, you're going to have a lot of your other funds in other markets, which hopefully are also doing better than the US at that time. So that's obviously the key reasons for diversification, right? You're averaging out your capital across a wide spectrum and hoping that you just capitalize the positives worldwide, right? So going up to its holdings, XEQT is an ETF that holds other ETFs. So definitely don't be concerned that you're going to be doubling up on management fees. That is not the case, but we are going to talk about management fees here shortly. So I'm just going to click on the aggregated underlying holdings because you'll see a lot of the same companies in here as you will see in VFV, but some key differences. We have over 9,000 different holdings in XEQT, but you're going to notice when we look at VFV that like Microsoft is there, Apple is there, Amazon's there, Nvidia is there, so on and so forth. But what I want you to pay attention to is that the allocation to these businesses, right? 2.75 to Microsoft. We got 2.66 to Apple. So just kind of take note of that because we're going to kind of focus on that ever so slightly as well when we get to VFV. The other thing that I do want to talk about is its it's management fees, right? So XEQT, like I said, is an ETF that holds ETFs underneath it. Now, the MER that you pay here is 0.2%, and that is what you pay. You don't pay any of the management fees underneath, and so on and so forth. So you're not doubling up because it holds ETFs. I just want to stress that because a lot of people do get fearful that they're paying a ton of fees, and that is not the case here. Now, what you are going to notice though is this management fee is higher than VFV, but you got to remember this is managing 9,000 equity holdings compared to what we're going to see in VFV being 500. So the fees are a little bit higher here, but I do believe that it is a good balance between diversification and fees. Now, again, I could, minus out this fee and buy the 9,000 equities myself, but I feel like I would be way more stressed, and it's way easier just to buy one ticker symbol and just be done with it, right? One thing is as well is that they do pay distributions. They pay right now, as of January 4th, 2024, their dividend payout was on average here 2.92% annually. So they do pay out every quarter, so it's 4 times a year. For a total annual dividend of 2.92. Now, I do want to mention though that I'm not sure if this number is a little bit skewed. It is typically in the lower twos. So I'm not sure if just because the last dividend payment was really high at 20 cents per share that it's skewing this at all. But I would anticipate if you're buying into XEQT, your primary is not because of dividends, but it will pay out roughly between 2 and 3% annually, 4 times a year. So that is XEQT at a very high level. So now let's go to VFV. VFV is on Vanguard's website. It is a Vanguard ETF. It is very highly sought after. It has done extremely well for performance, which we're going to get into the comparisons here shortly. But before we do that, we need to look at its underlying holdings and its management fees. So right to start with, you're going to see its MER is more than half of what XEQT is. So again, this one has less exposure, so it comes in at a lower cost. So you're going to end up having to, obviously weigh those balances as to what you like, right? Anyways, it does do the same as XEQT, where it pays out a quarterly dividend, and the distribution, I believe, is in and around that 1.15% right here. Yeah, 1.15 as of November 30th, 2023. So it does have a bit of a lower distribution, but again, it's primarily investing into certain types of companies that don't pay a lot of dividends because there are a lot of growth stocks, and we're going to get into that here right now. So like I had mentioned earlier, is that this one particular invests in the top 500 companies in the US. Its primary exposure is obviously technology because US is kind of a tech-centric country. It obviously has lots of other sectors that do very well as well, but the top companies within the US primarily are tech companies. So which companies are those? Well, you could have probably already guessed, but Microsoft coming in at the top at 7.3%, right? Remember in XEQT, we were around, I think, that 2.75. Apple being on XEQT was 2.66, and here it is 7.24. And then again, like I said, you'll see Amazon, Nvidia, Apple, Google, Facebook, so on and so forth. So you can see that you get a lot of exposure to smaller amounts of companies, and it's more focused obviously on tech because the larger companies in the US are tech companies. So one key thing I want to point out when it comes to considering risks is that if the tech sector has problems in any year that you're investing, VFV will be one of those ETFs that potentially have a worse year because it is very centralized on tech. So just something to be kind of concerned of, right? Also too, it is also less exposed. So it has a lot of more funds in single individual holdings, like you see here, 7.3% being a Microsoft, 7.24 being an Apple, so on and so forth. So again, those are the just a very high level overview when it comes to dividends, it comes to management fees, the holdings that we have. So now let's go talk about performance, because let's face it, VFV has outperformed almost everything. So let's get right to it. So to look at the performance, we're just going to start by looking at the backtest portfolio website. And you're going to notice here, I've just selected 2014 to 2024. And we're going to be looking at VFV at 100%. And if you've been a part of my channel before, you're already going to remember this, but XEQT was started in 2019. So I can't sadly do a comparison all the way back to 2014 with XEQT because of that. So what I did is I just took its underlying assets, which you would have seen when I was looking over the asset or the ETFs that it was held in XEQT. So, and I just kind of copied what they had on the website. So looking at this, you're going to notice how VFV portfolio has a 14.13 compound annual growth rate compared to XEQT being at 9.21. That is a massive difference. And like I said, if you look at the actual chart, you can just see the key differences. If you invested $10,000 back in 2020 or 2014 to now, we're talking big differences. So I understand why people, when they see these numbers, why would you even consider XEQT compared to just going all in at VFV? Because let's face it, over the last decade, you would have made some insane money, right? Going over just as another comparison, just taking XEQT out of the equation, taking VFV out of the equation, the portfolio backtest has methods of just being able to look at U.S. large cap, and then just the U.S. total stock market with global exposure, and I kind of just copied what XEQT would have for allocation comparing to 100% VFV. We basically get the same thing, but I also changed the date. So I went over a 25-year span. So from 1999 to 2024. And you'll notice, sorry, I actually said it was almost the same thing, but my mind was thinking something different. But we're at 7.44 compared to 6.15. So still, VFE would have outperformed XEQT over 25 years, right? So again, why would you choose XEQT over VFE? It makes no sense. Why would you want to, settle for less returns, right? Makes sense to me. So moving forward, I kind of just want to take a step back and I want to just look at just a few articles we see online. Now, this next one I'm going to look at, you're going to see the expert 10-year forecast for long-term asset class returns. So this is where we're going to be comparing U.S. equities, developed markets, which would be like your international exposure, which is the 25% in XEQT, emerging markets, which is the 5% allocation to XEQT, and bonds. We haven't really talked about bonds, so we're not going to talk about them here, but I do have other videos on the channel that specifically go over bond ETFs if you're interested. But you can see here that on Morningstar's website, they're actually predicting for the next 10 years that the U.S. equities are going to come in at around, this is what BlackRock is saying, which they are, in my opinion, one of the better companies that can do forecasts, as well as Vanguard, which Vanguard's got something crazy going on here. But anyways, so we're just going to kind of focus on BlackRock. And they're doing an 8.8% annual compound return over the next 10 years for U.S. equities. Now, when looking at developed markets and emerging markets, you can see here BlackRock is actually saying 11.5 on international exposure, as well as 11.8 in emerging markets. So again, one thing that I've learned in investing is sometimes you can't really take these predictions, because they also had said that 2023 is going to be a bad year for tech, and well, look at NVIDIA. They went up 244%, I believe. So, so you got to take all of this with a grain of salt. But the experts, and I'm no expert myself, are saying that we could see a difference, a swing from what we've seen in the past. So now looking at RBC's wealth management site, this is just another source where we're going to be looking at the performance of the global indexes. And of course, it says here the U.S. equities have significantly outperformed the other ones, right? So you can see the S&P 500 being way at the top, and then you got your Europe, your U.S. exposure, or your international exposure minusing the U.S. stocks, as well as emerging markets and Japan and Asia being in the negatives. So I just kind of wanted to quickly highlight this as another source indicating that the S&P 500 has been the outperformer. Going on to another source within the RBC Wealth Management, this is just kind of showing the U.S. and international markets trend over a multi-year cycle. So it says here, so for above zero, the U.S. market outperformed, and the below zero international markets outperformed. So looking from 1975 to 2020, you can see there's a fluctuation of cycles where the international outperforms as well as then the U.S. outperforms. And this is looking at from 1975. So this is further out from anything we've done before. And of course, the most recent one being when the U.S. hit its financial crisis there in 2008. So that's just something to kind of be aware of, right? And of course, it just kind of goes into the detail or the visual of just because it's a top performer most of the time doesn't mean that, or in the most recent decades at least, it doesn't mean that it's always like that. And the biggest reason why we would want to consider global exposure is because of the what ifs, right? So what if we go into a 10-year cycle where the US market is slow and international is doing the top, right? So everyone that's in VFE is actually going to be missing out on greater returns because they're on the US exposure only, right? So again, when we were kind of looking at the back test here, when we had a 14% compound annual growth rate from 2014 to 2024 compared to 9.21 with XEQT. What happens from 2024 to 2034? What happens if international is the actual best performer? I'm not saying that it is, but I'm just saying what if, right? It's always that case where you just don't know, right? It's always a magic 8-ball situation. If you base your investing strategies on purely history, and of course the most recent history, which a lot of people in my generation are closest to, right? So if I look at the last 20 years, the VFE or the US stock market has been tremendous compared to anything else, right? But if you talk to, like, you say, my in-laws, that wasn't always the case, right? So just something to kind of be aware of. Just the last page here that I have with RBC, they're also going over the price to earnings. And in here, they're kind of indicating that the S&P 500 has been over purchased, or the price to earnings is over what they would find as like average or acceptable. And I'm pretty sure the average is around that 20, if I remember properly. Whereas the international markets are indicating below average of price to earnings for the international and emerging markets. So again, being in the XEQT, you're going to be purchasing into these emerging markets potentially at a discount because their price to earnings ratio are below 20, whereas the US exposure is above 20. So that's essentially indicating overvalued or over purchased per se, right? Again, it's all about diversification essentially, right? So if, say, because of course XEQT has 45% in the US market. So what happens if it does flip, where all of a sudden price to earnings on the international emerging go above that 20 and the US drops down below the 20? Well, you bought into XEQT, say, years ago, where you were buying into the emerging markets while they were at that $16 price to earnings. So when they go up in value, you're going to capitalize on that growth substantially, right? So again, just something to kind of consider, obviously. So there you have it. That is the differences between XEQT and VFV. So if you were to ask my opinion, and that's what this whole channel is basically based on, is just my opinion, watch what I do. If you like what I do, maybe take the bits and pieces and apply it to your everyday investing as well. My recommendation, which you probably already knew if you're a subscriber, is that XEQT is my choice, right? Because I prefer to sacrifice, say, those last 10 years of massive gains on the VFV strategy. And I want to go the balanced approach because I believe in the long term of 30, 35 years, the US stock market is not always going to be on the top. So I'm looking at de-risking my portfolio at the sacrifice of, say, within this last 10 years of giving up some returns to have a portfolio that is ready to have that shift, right? If I was purely in VFE and the markets do change where, say, the U.S. stock market is having a struggle for growth, maybe they're in another 2008 financial crisis, my portfolio will still thrive because if the international markets are doing well, then I can have my US exposure lag behind a bit because my international exposure is carrying me forward, right? Another consideration to make too is that when you're going, you say you're near retirement, the probability, and I base everything off of probability, is that the probability that the US stock market could have another crash when it's centralized just in that country is higher when you have your capital spread globally, right? So just because the US has a problem doesn't mean Australia is going to have a problem, right? And it obviously goes in the reverse effect as well, right? Australia could have a problem, but then the US doesn't and they're thriving, right? So again, when you're putting all your funds into VFE, me personally, I look at that as more of a risk because if once I'm getting near retirement, there's a chance that when I need my money, that's when the US is going to crash. And then all of a sudden, I've just lost, say, 30% of $1 million, and that's $300,000, right? If I could be in a global diversified fund, maybe that fund lost 15% versus 30%, right? So just all things to kind of consider because again, it all comes down to risks versus gain, right? If you want to take the more centralized assets in the stock market, there's probably a really good chance that in the short term here, you're going to come out positive over an XEQT all-in-one ETF. But over the course of 30, 35 years, I do personally believe that XEQT will perform better than VFE. The other thing that people talk about as well is that because you're buying into the top 500 companies in the US, they're Fortune 500 companies. They do business in international areas. So if you're buying into VFE, you're essentially diversified. Now, that is a really good argument, and it is kind of tough to argue that. But if you do look online, you will notice that just say because say Tesla does business in other countries, they're primarily affected from the kind of the headquarters of where they are stationed, right? So if the US is having a problem, they will get severely impacted more than a country or a company that is completely outside of the US. So that is something to consider. It is a really good argument, but like I said, if the US primarily has problems, it does seem that if the company is primarily stationed in the US, they will be affected a lot more compared to not being primarily in the US. So I hope this was informative. Again, these are all my opinions. I choose XEQT among with many others. Your strategies, your risk tolerances are always going to be different than somebody else's, right? And the best thing that you can do is just be informed and make the educated decisions for yourself. So that is my 2 cents. I hope, even if you guys are VFE investors, I hope for best returns for everyone. And if you like this video, definitely leave that like below. Subscribe if you want future content like this, and I'll see you next time.